Started. Welcome to our webinar today on how corporate venture capitalists guide us towards a more sustainable and equitable future. I am Carolyn Alwyn, Interim CEO at Impact Capital Forum, and I thank you for joining us today, and particular esteemed speakers. We are so lucky to have you today. Before we get started, I would like to share with you some background on Impact Capital Forum. Founded in 2003, the Impact Capital Forum was previously named the Microfinance Club of New York. Since that time, the board has expanded its scope to address all aspects of sustainable investing, impact investing, microfinance, and social enterprises. Impact Capital Forum now has over 4,000 individuals within our constituency and our network. Most members are professionals within a background in financial services, financial inclusion, impact investing, fintech, and other large financial institutions. We host approximately 25 events per year on a wide range of topics relevant to these impact investing and social enterprise. Today, we are so excited to have a conversation on corporate venture capital as we discuss how the capital can empower social enterprises within our networks. Tammy Lin, one of our new members of our associate board, will be moderating today's panel. Tammy has a dynamic and diverse career spanning across 3 continents and 5 industries, serving a range of clients from education and retail to professional services and the United Nations. In her various capacities in both public and private sectors, Tammy has continuously assessed how to further the alignment of businesses with addressing our shared global challenges. Tammy recently graduated from Columbia University's SIPA with a Master in International Affairs and International Finance at the University of California, Irvine, studying business economics. She speaks 5 languages and bikes to explore cities and loves to enjoy and host global family recipe potlucks. Tammy and our speakers, we are so lucky to have you, and we're so excited for this conversation. Tammy, take it away.
Good day, everyone. Thank you for being here, and also thank you, Carolyn, for the warm introduction. It's a pleasure and honor to be with everyone here, this highly esteemed panel of corporate venture capital leaders. Hopefully, by the end of this chat, each of you in the audience will walk away with some new knowledge and maybe some inspiration. With that, I'll give a quick overview as why we're even here, and then I'll kick it off for our panelists to introduce themselves. As we may know, of the estimated $715 billion invested in corporate impact investments manage more than $7.2 billion. So when it comes to corporations and corporate impact investors having a position to empower early stage companies, they have quite the bandwidth. We see that back in August 2019, over 180 corporate executives from the Business Roundtable made headlines redefining a corporation's purpose, extending it beyond maximizing shareholder value to a fundamental commitment to all stakeholders. And since the pandemic started, we've seen several companies start to walk the talk, specifically by launching investment strategies to advance social and environmental causes alongside strategic and business goals. So with that said, we are so lucky to have this group of amazing corporate venture capital impact investing leaders with us today to give us greater insights as to how they align their business priorities to achieve maximum shareholder and stakeholder value. So without further ado, I'll let each of them introduce themselves. Maybe Ryan can kick us off.
Sure. Thanks, Tammy. In 5 languages, you're certainly humbling me over here. My name's Ryan. I lead impact investing over at Autodesk and Autodesk Foundation. We're using the sort of risk tolerance and flexibility of our philanthropic capital and the strength of our balance sheet to make investments in early stage enterprises that at scale can help move our industries towards more sustainable and equitable outcomes. And when I say our industries, if you're not familiar with Autodesk, we're a software tool maker in the design and make space for people who are making things. So architects, engineers, construction managers, product designers, and manufacturers. Some of those spaces that are traditionally just really difficult to decarbonize. And as we think about our future industries, innovation is a big component to how we accelerate that transition to a decarbonized economy. So we have a $50 million philanthropic fund where we are investing at the early stages, Series C, Series A, in early stage enterprises that can use design and engineering and some of our tools to be successful. We find we're really great at working at the early stages and bringing our technology and talent as a value-added partner to those companies' journeys. So looking forward to joining this conversation, and Tammy, thanks for leading us through.
My pleasure. Claudine, would you like to go next?
Absolutely. Thanks so much, Tammy, and Impact Capital Forum for hosting us today. And thanks to the panelists for joining as well. I'm happy to be chatting with this group. I'm Claudine Emeott, based in San Francisco with Salesforce, where I lead our $150 million Salesforce Ventures Impact Fund. We launched the first $50 million portion of that in 2017 and followed that up in October of last year with a $100 million commitment, building on the success from Fund 1. The fund is part of the broader Salesforce Ventures portfolio. So we invest with the same core strategy as our counterparts on the Ventures team. That means we're looking for best-in-class enterprise software companies. We're looking for companies that could integrate their technology with our platform. But on top of that, my team and I bring a specific impact lens. So we're looking for companies with demonstrable social and environmental impact in areas such as education and workforce development, sustainability, financial inclusion, and digital health. And we typically invest Series A through Series C, always as a follow-on investor as part of the broader syndicate, so not pricing and leading rounds.
Thank you very much. How about Ken?
Hi, good afternoon, everyone. I think I'm the only person on the East Coast today. Well, of panelists, Tammy, you and I are on the East Coast. I'm in New Jersey. I'm with the pharmaceutical healthcare company Merck, and in a group called Social Business Innovation. And I manage our impact investment portfolio. It's a $50 million commitment, of which we have committed $40 million so far. That's mostly fund investments. I'm happy to say that we've recently closed our first direct investment. And our investments are focused on improving the overall healthcare ecosystem in the emerging markets in the developing world for the benefit of underserved populations. And so when we look at that healthcare ecosystem, it runs the range from physical infrastructure like hospitals and clinics and diagnostic centers. We support research and development for pharmaceutical products and vaccines that have a developing world focus. We also have financial inclusion, things like health insurance, life insurance, and payment mechanisms. And then direct digital and diagnostics tools. And some of our investments are solely in one of those categories, and many cross over the boundaries. And so we expect to have committed our full $50 million either by the end of this year or by early next year, and already enjoying very nice social impact and financial returns on the portfolio. Happy to be here today.
Well, clearly, we have a wide spectrum of industries and expertise. Now let's move over to Canada and have Leah introduce herself.
Hi, everyone. My name is Leah. I'm based in Vancouver, Canada, which is on the traditional unceded territories of the Coast Salish people, specifically the Musqueam, Squamish, and Tsleil-Waututh. So I'm with TELUS and the newly launched Pollinator Fund. So our parent company is a telco, and at our core, it's really about how do we connect people and data. That's what our core competency is. But our CEO is also very passionate about how do we help connect communities and how do we help to drive innovation in our communities. And so we have a long history as a company in terms of volunteerism, philanthropy in our communities. And prior to this current role, I actually was on our TELUS Ventures team, which is our more traditional corporate venture arm, and was asked to figure out, well, how do we bring an impact lens to what we do, given, we have all of this purpose on one side and profit driving from a business and venture investment perspective. So put together a proposal, pitched to him last summer, and he said he loved this idea of a new standalone fund focused on impact while also proving out the returns aspects. So we launched in November of last year. We just closed our 7th investment last month. And so it's been a pretty busy pace, but basically we invest across 4 key areas. The first is around climate and sustainability. So what are we doing to be able to make a meaningful dent in our global greenhouse gas emissions, reducing waste? Our second is around health and well-being. So we actually have a TELUS Health business that's really the largest digital health provider here in Canada now. So if you go to a doctor or a pharmacy, chances are the IT behind the scenes, that's powered by TELUS. Late last year, we launched our TELUS Agriculture business. And so Our third area of focus complements that, and our working thesis there is food as medicine, looking both as food as an input to human health. And we know that there's a lot of comorbidities associated with poor diet or poor access to food, but also the health of the environment as it relates to agricultural practices. And then our fourth area of focus is really about how do we enable more inclusive communities. So really a lens around leveling the playing field for underrepresented or marginalized communities, of which Indigenous reconciliation is one pillar, but also looking at education and access to entrepreneurship. So we typically invest in the seed Series A stage with a lens to impact in Canada, but we have made investments globally as well. So 3 of the 7 investments we made are actually based in the US. So that's me.
Well, thank you for that. I think it's clear to the audience that these investors are very keen on making social and environmental causes of importance. So from the position of being within a corporation, I'd love to have Ryan level set for us and kind of define what is corporate venture capital? How does it differentiate from traditional venture capital, and how does it all relate to impact investing so that we all have a good baseline understanding to appreciate everything else that will be said going forward?
Sure. Yeah, it's interesting field. I think at the onset there, Tammy, you talked just about the market size overall of corporate impact investors investing in innovation. And, you know, the folks on the call here, actually, we put our heads together as practitioners here, gosh, maybe 18 months ago, maybe even a little bit before, just thinking about what the, you know, what this broader field of corporate impact investing looked like. And can we put some specificity around that? That manifested in a February Stanford Social Innovation Review article that I'm sure the folks can pass around a little bit. That's worth taking a look at. Yeah, in terms of a definition here, what we wrestled with and ultimately came out with at the other side was a definition around corporate impact investing being about making investments that are aligned with and amplified by a company's strategic priorities, their market position, their resources, in order to be able to generate measurable, mutually reinforcing social and financial returns. And I sort of listened to, Claudine, Ken, and Leah introduce themselves, and certainly it's true on the Autodesk side, but this, intention on leaning into what the core differentiators are of our individual businesses and the industries in which we operate, and how that sort of differentiation with some intentions around impact outcomes in our ventures portfolio can actually create greater value for our strategic priorities as a business and our customers in terms of the financial performance of the investments we're making, and ultimately at scale, the impact that these ventures can have within our industries. So that's the way in which I sort of think about this space. And while I think the absolute numbers on a market sizing perspective are relatively modest, I think you mentioned 7.2 billion, that's at least publicly disclosed. Mm-hmm. I think the growth rate there is interesting. So certainly some of the leadership from Salesforce and others, and being quite visible in this, you're just seeing more and more companies making these commitments towards corporate venture capital in impact innovations. And I just expect that trend to go forward, even sharpened by the sort of the pandemic and everything for the last 12 months.
Yeah, I mean, you just mentioned Salesforce, and I know that Salesforce is one of the larger venture capitalists in the space. So, I mean, we have Claudine here from Salesforce. Claudine, could you tell us a little bit about how the CVC impacting investment arm came to be on the Salesforce side?
Absolutely. So Salesforce has been investing with the corporate venture arm for more than a decade, and is one of the most active CVCs globally, with over 400 investments to date. And Salesforce Ventures has launched multiple thematic funds over the years, whether targeted towards a region or a type of technology. The Impact Fund, though, is the first of its kind, where, again, we're taking the core strategy of Salesforce Ventures, but adding an impact lens. And the origin story with the Impact Fund is, there's a broad recognition that Salesforce had, in its longstanding DNA, a very tightly held belief that we can build a big business while also doing good. And we see that manifested in Salesforce's early adoption of the 1-1-1 corporate philanthropy strategy, donating 1% of equity, 1% of product, 1% of employee time towards charitable causes. And that's very much part of the Salesforce DNA today still, and I think it's a huge draw for talent. But how could we evolve that kind of 1.0 version of doing business while doing good to also capture true business value and the increasingly strong muscle that Salesforce was building with its own corporate venture arm. And thus, the idea was born to launch an impact fund, building on the successes venture arm, building on its brand as a company committed to doing good in the world, and finding that intersection in particular in product areas that already had an impact lens. So when we launched the fund, we were very intentional about selecting areas to focus on that could tie back to our platform, such as our education cloud product or our nonprofit cloud, et cetera. And that continues to be a huge part of our investment thesis today. With every investment, we're solving for three things. We're solving for financial return, for demonstrable impact, as well as strategic integration.
That is three difficult things to juggle for sure. And
it is. Thank you for recognizing that. I think my friends on this panel would also agree with that. But it is the mantle that we bear.
Kind of I think that's interesting because I do think the impact investing space has obviously been around for quite some time, or at least this definition of it. And there can be perception that if you are taking concessionary returns, or that you can lose some sense of prudence in how you're structuring and executing your investments. And I think what I'm hearing from Claudine, and certainly I know from just the friends on the call, is it's a yes and, like, you were building from a traditional ventures or CVC type of diligence and structuring and the portfolio management with this additional layer of long-term thinking around impact outcomes that is more than what I think others may do. So yeah, there's plenty I'm sure we could tease out from that.
And I mean, I know that Leah comes from TELUS, as she mentioned, and had actually been in their traditional VC arm and then moved into the impact fund. So Leah, could you tell us a little bit about how you juggle those three almighty things from your side of things?
Yeah, and I think being part of a CVC arm helps prepare you for having this additional lens. So if you think about a more traditional venture fund, regardless of a corporate fund or not, the primary concern is driving returns along a certain thesis set, right? When you layer on the corporate aspect, now for us, within our TELUS Ventures arm, for example, and I'm sure Claudine's colleagues on the Salesforce side, it's how does this investment tie to our broader strategic elements? So there's a lot more filtering that has to happen as you're looking at deals, because it's not just, is this a good deal? Is this a good deal that ties with where our business is trying to transform, right? Because we're not looking to make investments that are just incremental. We're really looking to transform into version 2.0, 3.0, and evolve the business beyond being a telco, right? And so when you layer that on, it's also, in order to be successful to do that, you need the business unit integration element of that and a champion from the business. So that level of complexity, I think, gets underappreciated sometimes, and why we were laughing when Claudine was saying, yeah, it's a lot to bear, because it is, right? Not only do you have to find a good deal, you have to find a good deal that will fit with your thesis, and then now how do you bring on the business level so that they can help drive the return on that investment from a strategic perspective, because that company might still do well independently, but if they don't have the right hooks into your core business units, then you get the financial return but not the strategic return. And so what, how we contrasted was, rather than layering impact as a third leg to that stool, we said, how about we run these two funds in parallel? Because it's already a difficult enough piece to try to layer in that, right? But you're going to close that universe to even smaller set of potential investments if you now layer on the impact piece. And not to say that they don't converge, because we share deals with our colleagues all the time. But let's look at, from a financial and impact perspective, what that looks like. Because to Ryan's point, we want to destigmatize the sense that impact investing is considered concessionary. And I think the field is still advancing, and I see Ken nodding, but that truly is the case, where where I think the initial stigma was like, oh, this is more the philanthropy side, right? Like this is just giving away money. This isn't really expecting a return. And we want to be able to prove out that thesis because one, we believe that, but two, I think if you look at the data, you're starting to see more and more proof points that show investing in more resilient businesses, investing in more diverse businesses, investing in things that are truly solving human needs actually is good business sense, not just because it's the right thing to do, which I think we all believe in, but also showing that, the money will come with that, right? And so, we're really ambitious in wanting to prove that out. So let's make sure that we can show that without having other things anchoring that view.
It reminds me of the saying win-win situation, right? Sometimes people think it is concessionary, but win-win does exist. That's why the expression does. Ken, you nodded your head quite a bit in this regard. Could you elaborate a little bit your take on that?
I was not, tech investing have to happen by sacrificing financial returns. And Ryan used one of the phrases that all of us use, I think, in some form or another, which is that we're looking for a mutually reinforcing social impact and financial return. And so they should be driving each other. I'm sometimes asked, well, are your investments, are you impact first? And it's interesting how some people will focus on that, thinking that it has to be one or the other. Well, you're either impact first or you're investment financial return first. And I would say, well, we're looking at both. And while our company's core venture capital fund also, to Leah's point, has some kind of enterprise impact. I think all of us are in business. That the business exists because it has some kind of social return. Otherwise, I don't think any business could exist. And so there's always that enterprise social impact that happens. But what we're doing here is ratcheting in more of an intentional, explicit social impact in a way that now the state of the market and the investable opportunities that are out there can also deliver the same kind of financial returns that we're looking for. And I also just want to make another comment about the strategic value, another facet of strategic value, especially when we're working in either with new types of customers, non-traditional customers, or non-traditional markets where maybe our core enterprise business is not active, that by doing impact investing in these, in our case, in the developing world of emerging markets, we also have the strategic enterprise value of getting insights about working with those different customer sets, working with other partners, working in those geographies, which is not direct strategic value in terms of maybe closing a commercial deal, but it certainly is enterprise value that adds to our ability to strategically operate now and in the future in those markets. And I don't think that can be overlooked either.
Did anyone else want to chime in on this massive pillar of the balance of the three?
For some of my friends on the call, but the term that you mentioned there, Ken, just around mutually reinforcing social and financial returns. I wonder, if just some of the secular tailwinds we're seeing around consumer preferences changing, sort of regulatory markets evolving, and the capital markets being what they are, and the rise of ESG and other types of institutional capital with intentions around impact. Are those aligning these in a tighter way, this mutually reinforcing possibility of social and financial return? I'm curious what sort of broader market tailwinds you guys are seeing, or how you're seeing it inform both their business strategy and some of the ventures you're looking at within your own diligence process.
I think Leah is going to chime in here.
Yeah, I was going to say, I think there's some great points that you brought up there, because I think there's a few dynamics. I think definitely consumer sentiment has shifted a lot in terms of wanting to work or do business with companies that are values aligned. And especially through the pandemic, I think that's really shaken out, where people are now realizing hey, if I'm going to work somewhere or I'm going to spend my money with someone, I want to make sure that they're driving more good in the world, right? Just given all the socioeconomic and health challenges that COVID-19 has posed. I think it's been an awakening for a lot of folks, I think at a personal level. And then I think institutionally, companies are realizing that they need to step up and play a bigger role in this, because their shareholders are demanding it, their customers are demanding it, and their employees are demanding it, right? So it's coming from multiple fronts that are kind of pushing the envelope, where you're getting all these large pledges by organizations, right, to be able to drive change around climate, drive change around having more inclusive and diverse workforces and opportunities. So, and even education, you think about how much has had to shift because of COVID and how much remote learning, and you think about the populations that can't afford the same, private mini schools for their kids, right? And so I think there's a broader sense of awareness globally, but also I think now people are figuring out, well, what are the actions we can do, right, in order to make sure that we don't retreat back into the way things were, because I think COVID unlocked that there's a lot of things that weren't working for us, as much as there was a lot of good stuff that was happening.
I mean, with that and trying to identify like what good things that can be done, maybe Ken or Claudine can speak to a little bit as to how you define what is good, and how you also ensure the integrity of the good or impact that you define. I think oftentimes we keep tossing out the word impact, but it seems somewhat clear that it actually changes and depends on who's speaking. So if maybe from the corporate venture capital space, but also within your own firms, how you define it and how you go about that. Claudine?
Sure, I'm happy to kick it off, and I think it's helpful to get a couple of perspectives on this question, because it's definitely a meaty one. I'd say that on the plus side, our industry has evolved quite a bit in the last couple of years in terms of coalescing around more standardized frameworks and definitions when it comes to impact. That's often been, a noted sort of, I don't want to call it necessarily a weakness of the impact investing world, but unlike with financial metrics where we have GAAP accounting and standardized frameworks, impact has always and will always continue to be a little bit messier. That said, I think that the industry has really worked, as I mentioned, to bring some more rigor and alignment around it, while still allowing, importantly, for differentiation. We all might wish for a silver bullet when it comes to singular, easy to measure and report on metrics, but that's just not going to happen, because the problems that need to be solved are inherently messy and differentiated themselves. So what that means is that we as an industry are aligning around a general framework for discussing impact. And there I would point the audience members to the Impact Management Project, or the IMP for short. They've had hundreds of impact investors essentially, sign on to what they call the 5 dimensions of impact, which is a really helpful meta framework for discussing impact across 5 dimensions. So what is the problem that we're talking about here? Defining it both quantitatively and qualitatively. Who is the population that is impacted? How are they underserved? What is the projected impact, both in terms of breadth and depth of the solution here? What are the risks involved in the solution, either happening or not happening? And I think it's a really helpful framework for us, at least in our diligence process, to develop an impact narrative that's part of our deal memo. And so that is a key piece, is just alongside evaluating the financials, evaluating the market size, the product, the team, is really kicking the tires on the impact. And if we ultimately don't feel as a team strong conviction that this is, first of all, a big, important, thorny problem where we want to devote resources to trying to solve, at least in part, and if we don't feel that the solution is going to meaningfully move the needle, then it's hard for us to move forward with the rest of the deal, even if other aspects of it in terms of strategic integration or even financial profile look really compelling. If we don't have very strong conviction about the impact narrative, then that's enough for us to pull back from moving forward. And then on an ongoing basis, we collect impact metrics from our entire portfolio company, and we report on them in an annual report. That's part of our broader stakeholder impact report published by the company.
What I can add to that is just starting at the end there, similarly to what Claudine said, and I think everyone else, is aggregating the impact information that we get and reporting out on that. One of the challenges there, though, comes with how do you aggregate it in a standardized way? Because when you have different types of investments, they might all be measuring different types of impact. In the healthcare space, you can have, one investment might be measuring the number of people seen at a clinic, and another one might be measuring the number of people that use the diagnostics tool, and another number of people that use the financial inclusion app or something like that. So we need to find a way to synthesize that and aggregate it in a way that has a common denominator, just make it still be reportable and doesn't get caught up on too many levels of details. Similar to what Claudine was saying, we're looking from the start at the explicit intentional focus on impact in the investments that we make. And part of that is making sure that the investments have a objective, accepted impact framework that they're using. So we don't have GAAP, to Claudine's point, necessarily, because there are still a lot of different frameworks out there. But that's okay, as long as there's some framework that's being used, that's understood, and that's clearly communicated. I think that we probably will see some evolution towards more of a synthesizing of different frameworks that are out there. But it's hard because you can have an environmental investment that has very different impact from a banking investment. It's very different from a housing investment. So how do you balance all that? And I think the final thing I'll say is maybe the one thing that we try to look for is, yes, it has to be explicit, it has to be intentional, but also it has to be simple. And what I mean is it's simple in some measurement to talk about maybe the number of people that benefited from some kind of intervention. The further you get out from there, I think the more complex and then the more risky it is to report on different layers or concentric circles of impact. So you can talk about the individual that benefited from the intervention. Then you could start talking about the number of family members that are indirectly benefiting from that intervention. You could go further and say, well, how many more hours did the family members work? And then how much more money did they generate from their job? And all of those are valid to some degree, but I think the closer you can keep to the core beneficiary of the impact, I think the cleaner it is and the more reliable that kind of impact reporting can be, especially if you're looking at aggregating a bunch of different investments into one page.
And one of the things we also look at when we think about how do we define impact with the companies is how integral is that impact embedded in the core of that business model, right? Is every unit produced, is there some level of impact associated with that, or every unit sold or service provided, right? Because then that helps to better quantify it. And so, that's how deep we want to look at it, is that, they're truly contributing to solutions, because there are a lot of companies that are doing great work and, they might donate a portion of the proceeds to charity. But if that impact isn't more integral to the core of the business model, then it's a challenge, because one, as they scale, how do they help maintain that focus? And often the things that are optional tend to fall off versus if it's embedded. So every unit you're producing is reducing X amount of waste in order to upcycle to this new product. That's a very clear impact story that you can get around and align and measure. Right. I think oftentimes when you think about the companies you're working with, they're small. They're not going to have a team of 20 people who can go and measure this impact for them. So how do we help keep it simple for them to measure? And how do we help them figure out how that is embedded in their core business models, so that one, they understand that and keep that as their true North Star as they're building and scaling their business, and two, being able to measure it so that if someone asks, like, okay, well, how do you define impact? They've now got a very clear linkage to that. So that's one of the things that we try to do when we're working with companies and going through that assessment process, is understanding that and helping them to articulate that as well.
Yeah. And Tammy, if I could just add to that, for me, in my experience with our portfolio, this is much more of a positive than a problem. And so I can give a shout out to anybody that's in our portfolio that's watching right now, because we're going through our impact metric aggregation currently. And the impact that we're seeing is not only is it the magnitude just really impressive, but the types of impact that they're having and the people that they're reaching with the different interventions that are in the portfolio is just so encouraging to see, because we know that it's having that social impact. And again, getting back to Ryan's first point, we know that it will be building that cycle of mutually reinforcing business benefit. And when that engine is real, it really can have that impact.
One other thing I'll just say that's somewhat unique here for corporates is this idea that we are thinking about our role as capital allocators, but because we're in the four walls of a company, we act a little bit differently than perhaps like a institutional venture capital fund. In that we are impact investors in the allocation of our capital, but our businesses themselves are thinking about their role as being an impact investee for other pension funds or large institutionals. Or to what Leah mentioned before, just in terms that there's these secular trends where people want to work for purpose-driven businesses. And so I think how we are thinking about the roll-up in accountability around impact outcomes for our own portfolio will be the same types of sort of disclosures that I think we're feeling at the corporate level back to our shareholders, our broader stakeholders. So it's an interesting dynamic to be in as both the capital provider and rolling up into a business that is an investee of others, and what that dynamic looks like as we figure out the right type of frameworks and the simplicity of it to make sure that materiality between business strategy and impact is clear.
I think that point was very well said, and also reiterated in the SSIR article that all of you, like most of you, co-authored, right? The aspect of collaboration. And so we see that really come through. There are some questions I'm already getting in from the audience. As they slowly come in, I'll try to insert them in along the while, but I also wanted to not leave behind the concept of leadership. And while you do all of this and measure the investments and the impact and balance all of the things you need to do, how much is leadership at the corporate level involved into the impact investment aspects that you guys, activities, each of you do? Maybe Claudine or Leah can go ahead with that.
I'm happy to talk about our leadership and how they function here. We're lucky to be able to work with the GMs of the relevant product clouds, where we see the most kind of ties back to our impact focus areas. So we've developed strong relationships over time with the business leaders of Education Cloud, Financial Services Cloud, Sustainability Cloud, Health Cloud. And, we work with them in partnership to understand their build, buy, partner strategy. So we know what they're looking for is they're looking to improve their product through strategic integrations and partnerships that helps inform, our pipeline development in a proactive way. But vice versa, we can also help them because we're really kind of eyes and ears on the ground. We can be scouts for them about the latest technologies that they may not, get to see otherwise. And so it's a great relationship that we have. And it's also, it's our wedge into competitive rounds. Increasingly, with companies attracting traditional venture capital dollars, these rounds are hard fought. And it helps to have a powerful brand at your back and strategic value that you're offering when you're explaining, this is how we're going to help you. This is how we're going to help build value for your business by kind of opening the strategic suite of Salesforce to you. And that is with these cloud partners, but it's also with general assets we have with top talent across the company. So if someone has a question from our portfolio on sales enablement or pricing, for SaaS companies, we can connect them with an in-house expert who can lend their time. And that is really valuable to the entrepreneur, but again, is also valuable to me to be able to, leverage that portfolio development muscle that we've been working to build up over time.
That's a
Yeah,
great
and I'd say our experiences at TELUS are quite similar to what Claudine was saying, right? I think one is having top leadership bought in and supportive of this initiative. That's literally how we got this off the ground. Was our CEO said, "We love the idea, go build this," right? But also, on our investment advisory committee, we have our CFO, we have our chief social innovation officer, right? So they help to provide that broader lens and support for the deals that we push ahead. From a competitive dynamic, being strategic money, not just capital on the table, on the cap table, but actually being able to bring that value add is definitely a differentiator when we're talking to companies, because they're all at this point, at this inflection point to scale, and so they don't have the big company resources, but we can lend them an expert for a day to help them go through their branding ideas or product roadmap review, or if they're trying to figure out their enterprise sales capacity, well, we have experts who do that because that's what they do for a living for our organization, right? We have a medical advisory board. So if you're interested from a health perspective to get thoughts and ideas, well, we have people that we can tap into from that perspective. And then I think the other piece of a differentiator, especially being an impact-oriented investor, is that more and more of these impact-driven entrepreneurs want values-aligned investors at the table with them. And I've had more than a handful of instances where I'm talking to an entrepreneur and they're turning around and auditing me and asking me, well, what does impact to you? How do you measure, right? And really wanting to do their diligence on who they're getting into relationship with from an investment perspective, because it's not just about all the strategic value that we're bringing, it's, are you also values aligned in what you're doing? Because at the end of the day, they're going to be if you're an investor in them, you're there for the long haul. And so they want to make sure that the investors that they have supporting them in their organization are actually going to help them drive and achieve that, versus go down a growth at all cost mentality, which is what they're trying to avoid, right? Given they're very impact oriented with their businesses. So, I would say that's an additional level of differentiation now that we're able to bring to the table.
That's great. And I mean, I think that kind of leads and ties tangentially, but close enough to one of the audience questions. And, when you're dealing with these potential investments, could someone here on the panel elaborate on a specific investment and the dynamics how did that even look like? Leah just talked about the auditing of values aligned. Could one of you here, maybe I see Ken smiling, so maybe Ken speak to, or maybe Ryan, speak to one specific example of an investment that was made and how that looked like on the impact measurement side, on the entire short and sweet from beginning to end process.
Ryan wasn't smiling, so I think I get to start this one until Ryan starts smiling a little bit. But there he goes. So I'll be quick so Ryan can get it. So we just closed for our portfolio what was our first direct investment, having done just fund investments before that. And before I mention the investment, the way it came about is when we looked at our portfolio of funds, we had great exposure to Sub-Saharan Africa and Southern Asia, but we didn't have anything in Latin America. And so, coming in part from our committee, and a member on our committee challenged us and said, let's try to find something in Latin America because we care about Latin America. It's an important geography for us, and let's see what the opportunities are. So we started networking and looking to see what opportunities we could find. And we found that there really aren't any venture impact healthcare funds that cover Latin America. There are a few country-specific funds, and there are a few broad-based impact, but not healthcare focused. And so our process then turned to looking at direct investment opportunities. And we did things like host a couple of events to talk about venture impact for healthcare in Latin America at conferences and just with other partners. And that helped us build our pipeline of opportunities to look at. And we started narrowing in on a company that we started progressing with the due diligence on. It turns out it's a company that's focused on, it's a healthcare company, obviously, but it's focused on diagnostics for breast cancer, offering digital mammography services presently in Argentina, and really looking to expand into Mexico and other parts of Latin America. So the company's called Nanotest, and we ended up over the course of the past several months leading around to fund their strategic expansion into other parts of Latin America. And so from an impact standpoint, they're reaching underserved populations of women who need to get mammograms. And the good part about the impact is that they're doing the diagnosis earlier and cheaper and more accurately in many cases than the standard of care. And so with early diagnosis, you get better outcomes. It's saving the public and private systems, healthcare systems, money over the whole care continuum of the patient. And so we're excited about that and looking for good success as they expand in the region.
Well, I'm happy to give an example, because I think a lot of the theoretical we're talking about is best manifested in actually the businesses we're supporting. The last investment that we made that's public is in an early stage direct air capture company called Heirloom, which is using a novel process called carbon mineralization to try to cost effectively pull carbon dioxide out of the atmosphere, inject it deep underground or put it in as a value added input into other sort of products like concrete. For us, the measurement around that one's pretty straightforward because the company is myopically focused on unlocking the $1 trillion potential opportunity in air capture as its next utility. And so GHG emissions reduction is a kind of a one-to-one parallel for how this company thinks about its own business model, much to what Leah mentioned before. For us, why it's interesting, we are obviously a design and engineering company and can partner with the leadership team in the early stages around the design and engineering of the physical systems. Unit economics on these matter in line of sight to the economics that can get this compelling without needing the subsidy matters. And so as we think about what the potential impact could be at the early stages, we do some market forecasting of what we think the voluntary carbon credit market might look like, what a go-to-market plan in a technology development cycle of an Heirloom could look like, and do some thinking around where we as an off-taker with a price on carbon internally, plus where Autodesk customers who are making their net zero commitments can be a sort of syndication of demand for buying credits themselves. And we put all that together, we can get a sense of what is the pragmatic go-to-market strategy and how does that actually yield to impact outcomes for the business? And then what can we do like near term as we roll up our sleeves and help make that technology reality and get the unit economics to a point that helps to unlock that market. So yeah, very much so a lot of thinking about the future and then getting really specific about where we're the right partner and can make that go-to-market a reality.
That's lovely. I hope that answered the audience's question, gave everyone a better practical idea, tangible mindset of what CVC and impact investing looks like. There's another question. There's actually two, and I know with the limited amount of time, I want to prioritize the audience's questions. Very interesting. One of which is asking if any of you have ever been in a situation where investment could potentially cannibalize revenue elsewhere in your organization? And if so, how did you approach the situation and how did that play into your investment thesis? I think this was under the context that Leah mentioned in regards to that strategic value aspect of it and being very actively engaged and lending the in-house support. But if it's so aligned, how do you approach potential cannibalization of revenue? Leah, would you like to try to take a stab at it?
So we haven't had that come up in our world yet, but I think part of it is if you look more strategically, is that cannibalization or is that where things are going next, right? And so I think the way to evaluate something like that is to kind of flip it around. Instead of just seeing it as a threat, is that actually an opportunity for where the business could go next? But we haven't actually had that practical experience, so I can't really go beyond the hypothetical in terms of answering that particular question.
I'm happy to chime in. I think that this is an inevitable risk with any corporate venture investment, and it's one reason why companies are rightfully so sometimes hesitant about bringing on strategic investors, and why sometimes I want to keep them at an arm's length distance. I think that we're very, very careful in our analysis of the product, and in partnership with our cloud partners that I've already talked about, to understand any potential competitive dynamics, right? And certainly if there's any existing competitive dynamic, an opportunity for cannibalization, that would be enough for us to say, nope, like we shouldn't move forward. But there is often the chance that something could emerge in the future. And I have seen that happen. More so with Salesforce building something that becomes competitive with the portfolio company. And, I think that Leah's point is a good one. In one case that I can think of in particular, it's not acrimonious because it's not a fully competitive solution. There's a little bit of overlap. We're sort of bumping up into each other in the market. But thus far, that we see enough differentiation that ultimately I think that if we approach this in the right ways, which we are, that we have a great opportunity for collaboration and partnership. We have to recognize where there's overlap, but really let's strive to see where there's the complementarity and maximize on that front. But it is an inherent risk, absolutely.
Love both takes on it. And the aspect that you lastly touched upon, Claudine, was the aspect of collaboration, which now makes me want to ask Ken a little bit about how in the corporate venture capital in impact investing space, how does collaboration happen from the corporate VC level into the impact investing ecosystem? What does that look like? How much collaboration is there? I understand Merck on your end has recently been recognized by the UN EcoStock, as many as the other panelists have been recognized for in other aspects. Could you expand a little bit in regards to CVC in the impact investing ecosystem and the collaboration you see there?
Yeah, so thanks, Tammy. One thing I'll mention there that just made me think of is that when we look at our overall contributions to societal impact and focusing on ESG and sustainable development goals and things like that, impact investing is just a growth out of our traditional corporate responsibility and philanthropic work. And so we would say that we are actively engaged in the social impact ecosystem just across the spectrum of different tools that we have, whether it's philanthropic donations of financial resources or of our pharmaceutical products and vaccines, and then down the spectrum until we get to impact investing, where we're getting a financial return, but we're doing it so that we can have that social impact. When you talk about how we engage with the overall ecosystem, I think just being an investor gets us engaged in that ecosystem. We will participate in our investments with participating in a board, for example, of a fund or a company, so that we can bring expertise that we might be able to offer to the discussions about the growth of the fund or the growth of the business, and see what kind of contributions we can make that way. And then there's also the possibility for synergies between investments and looking at companies that are in one portfolio and seeing if they might be relevant for discussion with another fund or companies in the portfolio of another fund, because on the one hand it's a small community, but everybody doesn't know everybody, and so there are ways that you can bring partners together. And then I would say the final thing is, like all of us, participating in conversations and dialogues like this, because as much as we know a little bit, I think, about what we're doing, we also all have a lot to learn. And so we look for opportunities that we can both contribute, but also participate as a learner and see what we can learn from our colleagues so that we can do even better what we're already doing.
I see a lot of head nods. I think we're all in agreement there. I want to squeeze in one last question because I see that it was sent by the audience member and has been prompted multiple times. How does one incorporate DEI into corporate VC investments? Is it part of the broader DEI initiative of corporations? And that'll be our last question, and then we could go into closing remarks. Does anyone have a take on that really quickly?
I think that it should be. I didn't mention it, but we have a mandate that underpins our entire fund strategy to build a diverse portfolio and maintain a percentage of at least 50% or more of our founders, CEOs as women or underrepresented minorities. And right now, I think we're at 62%. So proud about that number, but there's more work that we can and should do. But it's a great question. And I absolutely think that it is part of this puzzle. You know, a lot of the problems that we're solving are, you know, tackled by entrepreneurs in our portfolio who have lived experiences with them. And I think that that is really valuable when you're starting a company and you have direct experience with that challenge. I think it's a powerful statement to then go out and do the hardest thing ever, which is start a company and tackle it. But it says a lot about the person at the helm. So we're proud to support a diverse portfolio, but always have more work to do on that front.
I mean, I think
I'd echo what Claudine is saying in terms of when we think about how do we build more inclusive communities and how do we have solutions that help to support diverse populations, you need to have that reflected in the companies themselves, the leadership team, the employees, as well as the investors. And so we also have an internal mandate of, you know, at least 50% target that we're working towards. So of our 7, I would say I think we're above 50% right now, but we're still early days in our fund, right? But I think it's allowing us to tap into new markets that we might not have normally had purview to, which is great because that means we're unlocking more market opportunity and we're truly finding solutions that address the needs of those populations.
I think it all ties us all full circle about the social impact we want to do, whether it be from an environmental front, from a representation front, or all the other SDG 17 goals that there exist. With that being said, it's been such a pleasure listening to all of you, sharing your knowledge. I'm sure the audience has taken away quite a bit. Clearly, there were so many questions that we still had to answer, but thank you for making the time. We're a minute over, but I wanted to leave another 2 just if there's any closing remarks from any of you, last words for those that might be interested in the space, things that you hope to see in the future. Maybe Ken, you can jump us off and we'll go around really quickly and then wrap it up.
Just saying thank you. Great opportunity. Nice to see everybody.
Thanks all.
Yeah, if I have just one call to action for you, Tammy. I think as folks think about value creation at this intersection of financial prudence and returns and social impact, I think those folks generally speak different languages and come from different camps. And so a call to action is, if you're on the financial camp and reflective about that, think about the language of folks across the aisle. And if you're on the impact camp, think about the language across the aisle. And I think that there's a lot of value in that intersection there, and it requires true collaboration. So that's what we're all teasing out here.
Yeah, I think the big takeaway related to what Ryan's saying is it's not either or. It's not can we drive impact or can we drive returns? It's how do we do both, right? And so it requires expanding your assumptions as to what can be achieved. And then I think there's a growing community of practitioners like ourselves and others that we know that are really passionate about the space. And if you want book recommendations, I've got a whole bunch of that I've been reading. There's this media one by Mark Carney. It's like 700 pages that I'm about to dig into, right? And he's the former Bank of Canada governor and then the Bank of England, and is big now proponent around climate, right? So you're seeing people crossing the aisle, so to speak, as Ryan was saying. And so I think, if you're curious on either side, start exploring and having conversations with folks. You never know where they might lead you next.
Well, thank you for sharing your perspectives and the way you look at this language and sharing that with all of us today. I'll close it off now, and we'll see all of you continuing doing your great work. And without further ado, just say thank you.
Thanks,
Thanks,
Tammy.
Tammy.
Thanks, everyone.
Bye, y'all.
Bye.
Everyone.
Everybody.